Excellent. All right, everyone, thank you for your patience while we deal with technical difficulties. Welcome to June's Jobs and Inflation Reports update with our Dr. Reilly White, who is the Associate Dean of Teaching and Learning and Associate Professor of Finance at the University of New Mexico. Um, Dr. White is our resident economist and we've been doing this for about 2 years now. And every month we get together, we discuss Team Econ Olympics. Hello, Aaron. Every month we get together, we discuss the jobs update, inflation update, whether or not there's a recession happening, how are jobs, what's the best time to get jobs? Is it the worst time to get jobs? Is the government gaslighting everybody? Is the job market good? Is it bad? Is it, going up, down, left, or right? And with that, we hope to help people be more informed about their job search and whether they're looking for a new job or job hopping to take advantage of a good market where you can negotiate for better salary. And with that, I'm going to pass it over to Dr. Reilly White.
Thank you so much, Colin, and welcome everybody. It is great to see everybody here on this fantastic and glorious Monday evening, kind of, and toiling wherever it is you are. Thank you so much for the introduction, as always, Colin. It's an honor to be here. Can't believe it has been a couple years. We've been doing this for like an age. It's been so long, but it's always good. Of course, I love seeing, especially people who endured this once before and have since come back. But if you're new for the first time, a couple of quick notes. Please ask me anything that you'd like. And of course, be careful. So if you're driving on your way home, or, operating heavy machinery, doing lifting and a complex agricultural environment, please let me know, and I will, no, don't let me know, but please operate this safely and we'll handle it from there. What we're going to do today is we're going to cover a swath of economic questions and answers, and I'm going to provide some answers to some questions that I received. I also want you to ask questions in the chat, and the cool part is we got Aaron de los Reyes here today. He's here to ready to rock and roll, and what Aaron does particularly well is follows up with the links, with the data, with all of the stuff to help you understand this. And I am so grateful for him. So we're here today to rock and roll. So let's talk about a few things. We had some good questions, and I have the questions up in front of me. I've also got the presentation I have today. So we'll talk about a few things. We'll talk about the job market, inflation, of course, normal things. We'll get into the two political roles in the candidates. The candidates have both come across former President Trump and running, of course, having seen Biden dropped out, the Harris campaign. What does that mean, especially when it comes to a couple of major economic issues that we're going to talk about? I want you to ask and anything and see what it is, and share your feelings about these situations within reason. And one of the things here that I want to share and express is economics is very imperfect as a science, and it involves consistently, but we look for it is a systematic overview of the ways of man and the foibles within. And so what we're going to do is take a look at some of those foibles this week. Yes, more jobs lost. Nancy says, looks like more job loss in the San Francisco Bay Area. We're going to talk about that too. And not just here, not just through this AI generated image of, relative questionable, methodology. And artistic talent. But there is some more information to this that we can discuss. First of all, the jobs report was good, but it could have been better, and it came with some bad news attached, like icing on the cake. Some unfortunately bad news, like icing you don't like. It's it's a Limburger ganache, if you will. So June 2024 jobs report. Here's what we have. Jobs are up, but so are the downward revisions. We added 206,000 jobs. Unemployment rose to 4.1%. Participation increased, and that was used as a justification for that. What is the unemployment rate? The unemployment rate takes the number of workers who are either who are looking for a job divided by the population of people who could have a job. So if you aren't actually looking for a job, you're not counted in the unemployment rate. And this is what's called U3. This is one of a number of unemployment statistics that are covered by the government. And so 4.1%, it went up a little bit. This is the first time in over 2 years we've seen that rise above that 4% level definitively. And that is continuing that trajectory of a weakening job market. And where do we add these jobs? Where are these things going? Where's it raining? And what are we talking about here? And it's again, and I feel like I'm on repeat. You could take last month's session and the month before that and just replay this section back and forth again. And we have 82,000 jobs in healthcare, 70,000 in government. But the good news is we have 27,000 in construction. In June, construction picks up around the country. That's to be expected in a growing economy. So far, so good. But healthcare. For all the jobs. And as we know, we spent such a high percentage of our GDP on healthcare, as we've never really figured out how to grant that access to healthcare to a large swath of our population. As a consequence, we pay up the wazoo for healthcare and related expenses. But it is continuing to grow demographically. It's a very positive environment when investors are looking to speculate on where they're going to build new businesses. It's a hospital, it's a clinic, it's medical support services. All of that is a growing business as this cadre of baby boomers ends up running through this session, and they're retiring right now. They're getting older, their medical needs grow. One thing that's persistent about when we study retirement age populations over time is that your medical expenses go up exponentially. And that's why many people who think, hey, I've got it made for retirement, I saved for years, end up underinvesting because of needs like long-term care, et cetera, et cetera. So what we're going to do here, and this is right too. Oh, we got Sean in the room too. My goodness, we got Sean Reilly, the other Reilly with the last name Reilly, and we've got Aaron. It's been tough since we've had a combo of both of these folks with us today. Sean says healthcare spending in the United States. I was going to quote 16%. Sean says 18% of GDP. Wow, 18% of our gross domestic product. So that is. God, that's what, $4 to $6 trillion, basically. What a stunning sum of money to spend on healthcare. So, growing business, and if you're looking from an investor's point of view, they see dollar signs. And so they see hiring, they see staffing, they see all of these needs. And where is it disappointing this month? And I know we hear this as well. You're like, oh, but the media says jobs reports are good and all these other things. And people write to me and they say, this doesn't make any sense. Why is everything so positive? I go outside of my house or home or condo or shared condo with 12 other people in the Bay Area, and I walk outside and the jobs market's not so good and it's not so terrible. I've sent out 200 resumes and I've got one called back. I hear things like this, and it's such a challenging environment. And you're absolutely right. Professional and business services, a place where, when we look at that sector, everything that supports businesses, from your accountants to your lawyers and everything in between, that had a disappointing month, losing 17,000 jobs. And manufacturing and retail services were also down 8,000 jobs. And in the words of Stephanie, oh, it's good to see Stephanie again, womp, womp. For this again, double the womp, double the shenanigans, double the disappointment. Labor force participation increased slightly to 62.6%. So workers are participating more or less. Here's the deal with participation. We maxed out in about 2001 with our aggregate labor force participation across the country. Tech recession happened and it never came back. Why was it really high in 2001 and why has it gone down since then? That's the number of workers who have a job or are looking for work divided by the population of workers there is. And so if you retire, you're out of the participation rate. If you go to grad school full time, you're out of the participation. If you do a lot of things, you drop out of the labor force, you're out of the participation platform. And this rate has gone down from, it was closer to 70%. It's gone down to the mid 60s. Now it's in the low 60s. Much of this is demographically driven. Baby boomers, we had the rise of employment, especially in the 70s, 80s, and 90s, when women joined the workforce in mass, and we had all this giant generation of baby boomers in the market. Now that's gone down. They're retiring. They're dropping out of the market. And as a consequence, we're not replacing those workers back. We're becoming an older country. And that means also we've got some challenges in meeting those worker requirements. And that's why these participation things, they'll go up and down 0.1, 0.2 in a given month. But next recession that happens, people will leave and they won't come back. And our participation rates in the good times after that will be even lower. So Melanie, this is a really good question. Do gig workers count as labor force participation. So participation in all things is determined by survey. So it depends what you say within that survey. So if you consider yourself working and you have a job and you report that job, that's something that would incorporate, you would be counted in that survey for labor force participation. But, and I put this is a big but as well, if your gig work is particularly unreliable, you just finished a project with client A, you don't know when project with client B is going to come down the line. It is likely undercounting gig workers to the tune of probably millions, Melanie, millions. And casual contract workers, when they take these surveys, probably don't consider themselves employed as the same way as other people do. And so, as you would be, because you're like sitting there looking at somebody with the 40-hour job, the 60-hour job, all those other things, as a consequence, and your work going between clients who are irregular, and they signed up and signed your contract, but they don't pay you, or they try to minimize how much they have to pay you, or they decide that, hey, this work isn't really done, please send me an invoice, and they go MIA for 6 months. If you've had a gig job before in your life, you know what that feels like. So double check on any of those things, but most people believe it's undercounting this. So it's probable that as we go through this next economic cycle, participation rates, unless it figures out a way to count that, will be skewed downward because of that loss. Great question. Yeah, look at that, Nancy. Oh man, this is good. I like the tone of today's chat. This is just making my day. So Nancy says, no need to feel despair, cut spending, leverage your 401k so you can get guaranteed income for life. And Colin says, oh my goodness, geriatric care going to charge as much as possible. That's true. Some places negotiating to take your house after you pass. This is a really important thing. And boomers can't live with their kids because the kids can't afford to care for them. This is a true story. If any of you have had an elder relative or grandparent or other folks who needed long-term care for the first time, it is a devastatingly expensive venture no matter where you go. You can't, I keep trying to find like a price line for this, but you look at this and it's an incredibly expensive gesture. I remember when my grandfather, he sold his house in 2019, right before, it was 1 year before he passed. And he sold his house for like, I don't know, it was like $160,000. So not tons of money, right? But he ended up needing long-term care after that to the tune of about $7,000 a month, which basically took out whatever savings he had left, and just to pay for that. But conveniently, or not so conveniently, and very unfortunately, he was an awesome man. He passed away with just a year into long-term care. There is a likelihood because of demographics and survival rates, and if you check out the Social Security Index actuarial value tables, if you're looking at something fun to look up or morbid to look up at the next Thanksgiving meal you have with your family, it'll tell you approximately the likelihood of how many years you got cooking left. And as a consequence, if we study that and then we look and analyze and say, hey, what are the odds that either yourself or your long-term partner lives to be 90 years old? The ratio is much higher than you think for a nation with a life expectancy that's kind of dropped and kind of come back a little bit. About 50%, which is extraordinary for those people who already make it to the age of 65. And as a consequence, that is a huge deal. So all of this is super, super important. All right. Oh, glass half full. Oh, yes. I'm waiting for the half full. Yes. Glass half full. Yes. There's good too. Yes. No, it's not all darkness. And there's good things if you're in healthcare. If you are providing health services, the outlook is bright. If you're a long-term care entrepreneur and you're marshaling the forces of private equity to then take that money and charge these people tons of money to provide that care, because it is a very expensive business, you are doing wonderfully well. So that's the good news. the lower bound for expected standard of life has never been higher than history. Also true. This is very interesting. We haven't solved this question yet, and it's likely unsustainable. Here's where the bad news bears comes in. April numbers were revised down 57,000. May were revised down 54,000. Put those two numbers together, what do you get? 111,000 jobs that there are fewer of than where we thought we'd be at this time. And what does that mean? Why does that happen? So when these employment surveys are released, they have an incomplete data set. They say, oh, based on where we hear from our corporate data set and all this information, this is where we stand with the jobs added. And then there are other factors that come in throughout the month, where people are like, well, this happened and this happened, so this number really isn't that high. And so they make these adjustments afterwards. And the tendency to see two negative adjustments like this back to back, that is bad. And that is something that means that we have a very much more pallid job market than we thought of originally. Again, no surprise to people here, especially I wouldn't be doing victory laps. This is tough. Even the most optimistic of people that I follow in this job analysis space, we're like, it's definitely a weakening market. And they kind of go, oh, it's one of those things. As I spill my iced tea, which way and that way. But here's what we got. So other ways to look at this that might be a little bit more interesting. So in addition, we know that information sector, good news about information is you didn't lose jobs. You gained 6 across the country. However, that is not an exciting jobs report by any amount. Tech normally can fall. Karen, that's a good question. Tech falls under partially information. It may also be, depending on what you're doing, incorporated as professional and business services, especially if you're doing a lot of work with them, work with tech companies, around tech companies, or reliant on tech companies, or even within tech companies in non-programmer type roles. You'll be doing things in professional and business services. Information sector is going to be a lot of the other tech jobs. And so this is what we see San Jose, San Francisco as being a particularly large sector. Good news is, in the recent jobs report released in June, both San Francisco and San Jose showed increases of about 2K each in jobs in this area. So it's not all going to Texas. There is some bounce back, and it also means it's not all negative. It is not, though, an exciting hiring report in the sense that people are really jazzed and companies are going out and hiring people on the street and saying, how'd you like to program for me? Let's do this kind of thing. And it's not like somebody in a top hat and a monocle is asking you to is going to shower you with equity options as soon as like they did a few years back. Instead, it's a much trickier road these days. So let's talk about wages. So, but first, good question from Nancy. Would you incline to say the economy today will most likely change after the election? Ooh, good question. The real question, Nancy, that is a $64,000 question. Most of investors are putting their investment on hold, with exception for a few daring companies in semiconductors. And there is reasoning for that. Both candidates offer a starkly different view of how they would manage the economic situation. And I'm going to get into that a little bit about a couple of things. But it is true that if we say impose a tariff-based economy, that has a bunch of negative externalities that would be bad for the economy, including passing on expenses to us. And it is likely, I think, that a Trump-Vance presidency would be interesting. It would change some of the economic landscape significantly depending on what was passed to that economic agenda. I think with a Harris presidency, you would have a very similar trajectory to the trajectory we're doing right now. And so the question is what will happen and when, and will either one of these presidencies increase the likelihood of a recession? Note that we are in a weakening job market. Things are weakening. And what the Fed does also plays into this. And we often posit that presidents often have a really big and magnified effect on economic situations, when in fact, sometimes they don't really. They can institute, and their party can institute economic policies that have an effect on the economy, but the economy is often much bigger even than the president with regards to what happens within them. And so that's a very good question. Aaron says, fixed demographics, so we all work until we're 80. That is on the table when we ultimately receive our Social Security payments at the age of 85. Julie says, or like my mom, spending her retirement years taking care of grandma, who will probably outlive her. Oh, that sounds just terrifying. That's so challenging to do. A lot of people are in what's called that middle-age squeeze, where you've got to take care of older parents and you potentially have to take care of young adults as well. So that happens as well. And if you're in that role or have other people, your mom's in that role, that's something that is really challenging. Nancy points out the wage issue is insane due to Gavin Newsom's recent wage hike and the backlash. Colin says, I thought AI and automation was going to free us from jobs so we can do art and all the self-actualizing activities. No, instead, AI does all the fun stuff. I need AI to do my house, Melanie. I would let AI do my household chores. I also, Melanie, that is great. I would do the same thing if AI could do this, and I hope one day, uh, and I spend all my savings on one of those Elon Musk robots that walks around and doesn't do any chores for me. But I ask it, what's the forecast? It'll be really, really awesome. That's my hope, and it will. So, I know. Nominal wage growth and average hourly earnings for all workers. This is an interesting chart. You can see that wages, while bouncing back during the COVID pandemic, have since kind of been on this downward slide in terms of their trajectory. We are still positive wage growth, 3.5% to 3.9%, depending on the year over year or 1 month change annualized. The longer rates are nicer because you can see smoother rates, and that helps us figure out trajectory a little bit better. But in this rate, you see that, hey, a wage growth of 3.5%, inflation is still cranking along at 3%. Not a lot of real wage growth, but it is there. However, this isn't, gangbusters wage growth that would lead us to suspect that this is going to drive inflation further. So the Fed sees this, no increase in wage growth, tighter job market. Maybe it's time to cut rates, they're thinking. Jerome Powell rolling up his sleeves just a little bit in the last couple of weeks, saying it's coming and we should perhaps think about this soon. So, employment to population ratio of workers, if you're between the ages of 25 and 54, but from 1989 to 2024, we have about as high as can be the percent of people in this workforce that are physically working, about 81%, and that's a pretty good number. A lot of people are like, those 30-year-old kids aren't working these days. No, they're working. Everybody is working, as it turns out. But can we sustain this for much longer? A good question. Often these numbers happen at the height of economic cycles, but we've been kind of steady in there for the last year. Hopefully we'll be able to do it in the future. Very nice. There's really good conversation, Nancy, Melanie. Aaron, start a new party, the Social Democrat Economics Martyr Guilt Party. Oh, that sounds very exciting. Oh, this is taking a turn. Now we've got this is another one that's a very interesting thing when we think about the change in the unemployment rate we've seen. We know the unemployment rate has gone up, but why has it gone up? And so if we actually break it down a little bit, and this is Parker Ross's chart, it's fascinating. The amount of people, the reason that people are being unemployed is, as you might expect, in fact, they are job losers who are on layoff or not on layoff is the biggest one. Only a small percentage are actual re-entrants to the labor force and new entrants, that increase in participation rate. And so the unemployment rate is going up because people are indeed losing jobs. That's self-evident, but this is something of a debate that's been happening in economic cycles. Are more people confident about the market? And as a consequence, is that pushing the unemployment rate upward because more people are looking for jobs? Or on the other hand, is it something where people are actually losing their jobs, and as a consequence, the traditional view of unemployment? And it seems to be the latter, that people are losing some jobs, and well, we've got ourselves a higher unemployment rate now. Now, this leaves us down to a few things, and this is one of the few things we're observing. So one of the questions I had was, why does the media keep saying the economy is doing so well and so many white-collar professionals are being laid off? And this is why. And one of the things with the economy is that we have this, since the last 60 years, since the dawn of economic coverage as it pertains to newspapers and other media, in anything, we always fall into sort of this aggregate data is the determinant of everything. And this is the true story. And it is a good determinant of generally where things are going, but we've gotten much more nuanced in the last 3 decades. Example being, for instance, right? Like 3 decades ago, we would have said, oh, free trade, no consequences. That's great. Let's make that happen. But we know that free trade has consequences, even though it's good for the economy in general. GDP goes up. Tell that to somebody who's been working in a factory in Detroit for 30 years and finds himself laid off. And then or tell our agricultural policy to somebody, in Chiapas who in the 1990s saw their market flooded with cheap American corn. And economics is littered with this. We have a situation where even though, yes, aggregates are good, and this is the thing that's good for most people, sectors suffer, and sectors suffer often. The information sector in particular is cyclical, and it is incredibly, notoriously cyclical. And right now, we've moved from an era of cheap, free money, which powered a lot of AI investment and investment in a whole bunch of different things going back for the last 10 or 15 years, into a more expensive financing model, which means that companies are being more careful about the way they're building and lending, and as a consequence, growth goes down. And this is what happens when the cycle tightens up a bit. And then when the stuff is dark and the economy is negative at some point in the future, which will happen, it'll be the tech sector that'll say, hey, look, cheap money, and they'll invent something and it'll be great. And it'll be an AI that does, housework, and it will come back again. It just so happens that the nature of this argument is that it is very tough for individuals, even when aggregates are good. So let's think. So let me go back a few bit here. Nancy says, I was at AI conference several months ago. AI will be one of the causes for lost job unless people get on board the AI train. Do you happen to have wage statistics? Good question, Nancy, on AI. A few things about AI in general. I'm not a Malthusian. Thomas Malthus was an economic theorist who basically said, new technologies puts people out of work and those jobs don't come back. Those jobs do change. It does put people out of work, and people will be put out of work. But putting this in a context, I always bring up the example of a telephone operator. We didn't need telephone operators starting in the 1920s, but we still had them all the way up until the 1980s, in fact. So the way that technology gets disseminated throughout a system, we've written some papers on this too. We're fascinated by the intersection of finance and technology, in particular, me and my co-authors. We do some peer-reviewed work and some stuff that looks at innovation and how it transmits itself through an economy. It's not linear and by any means, and it's not these things. And what you'll find job losses, Nancy, is that where AI will manifest itself in job losses is there'll be a recession, and work that's redundant will be consolidated. People will be laid off, and then those jobs won't come back the same way. And that's the most often case where we see this. It's not, oh, suddenly I figured out how AI does, and I'll write a story with it, and it sounds like an AI written story. I've got a friend out there. He's writing 60 AI books. They're written by AI. They look like they're written by AI, but they're kind of fun. But there is not that equality yet in those two situations of somebody who's actually an author and actually is tedious and thoughtful about the way that they examine their books and their details. Karen says the only question we can maybe answer is if the Fed lowers interest rate before September or after November, and what would impact? Would we see another month of weakening job market? So Karen, this is interesting. If the Fed lowered rates, think of the economy as a slow-moving battleship. The Fed can lower rates to 0 tomorrow, and we'll still have a jobs report next month that'll be, I don't know, 150,000 jobs added, 100,000 jobs added, and we'll still be talking about the same thing. But it'll really ignite investment, which will help us 6 months in a year down the line. And that's why the Fed is seeking to act in a way that's prudent, that doesn't bring inflation back, but also at the same time enables sort of a jumpstart in the economy in a meaningful way. But to your point, even if they cut rates 1/4 or 0.5% this year, it won't show entirely in the rest of our jobs reports. But our best goal is that cutting rates saves us from a recession and presents us with a positive avenue for economic growth in the future. Colin says, if the consumers start to show a distaste for AI-created products, will that cause a shift in industries? Yes. But here's the thing. I have great faith in humans' ability. We view technology, and this is actually something that just came out. People were surveyed on what they found as the most important thing. And let me grab that real quick. The biggest improvement in life in the last 50 years, 42%, more than any other people, said it was technology. 14% it was medicine. 10% it was civil rights. Fascinatingly, technology has our heart, even if our minds are elsewhere. And so AI as itself, I think, will be different. I think people will learn how to use them. And I think we're going to separate from a time when the internet was new in the 90s and people knew internet important, but they couldn't decide which was Amazon.com and which was Pets.com. We're going to go to a situation where this industry will shake out into specific services that they provide in a meaningful way based on how people actually use them. So like the internet, you're going to see a lot of things thrown at the wall in products and services, and what's actually used, there'll be good things. Wage statistics by industry. Good question, Nancy. Yes, I can find that data. I have to get that now. Sean says the dismal science. AI can do analysis a lot faster than human can. Agreed. That is true. the danger AI can bring. You're absolutely right, Nancy. So one of the things too that we think about in academia a lot is, we pride ourselves on our research and our papers. I'm waiting for the time when I can give AI a data set of my data. It comes up with the hypothesis, runs the hypothesis, runs a statistically robust set of information on it, writes the whole thing, just so I can pop that out and call it a peer-reviewed pub if it gets through the door. And it's interesting. We're not really there yet, but I know my colleagues are like, well, we're there. We're not there. I've tried it. We're not there. But we're certainly going to be there in a hop, skip, and a jump from now, which has a big effect on how we do a lot of things in our economy and where we have some of those incentives. Sean, the dismal science. That was in response to my mouth is Rethins. Thank you. I love it. It is the dismal science, Sean. We all study this because it's fascinating. Marcia says, I'm not convinced of user perception of AI will matter much. Instead, it'll be more about what we realize productivity gains. I like that point, Marcia. That's very good. Or cost reductions at scale. Currently, it's more spend than gain. Absolutely true. And scaling is important. And I think this is interesting, Marcia, because you're not wrong by any means. I'm of the opinion that I think both will happen. I think user experience often drives our perception of products and services in a way that's meaningful. And as hypothetically good a product or service might be, if people don't see it as useful, they won't use it. And that's the same for an end user in a consumer-oriented environment as it would be for a mid-market manager who's trying to rationalize the use of AI in a meaningful corporate setting as a way to generate such productivity goals. And Aaron says the big stories are rolling 3 to 5 month PCE is now 2.7%. This is huge news. Bam, bam, bam. Now we can finish crushing inflation, which is ending a few days ago. Now it's good. That's true. Oh, yes. Marcia, thank you so much. This is good. Is that your first question, Marcia? Let me know which question it is. I got 10 pre-submitted questions and I'll hit them up gradually through this. AI is at the infancy stage. AI was a pre-submitted question as well. Tapping onto the pre-submitted question of AI, considering the impact we've been expecting on jobs and employment. We're still in the early stages. Is the current level of CapEx spend sustainable, or should we see an AI winter or delayed time to realizing return on our investment? I think investment's going to be solid, and I think it's going to be substantial in the future for that pre-submitted question. I think we have seen AI. People are like, oh, it's blown up, and it's not. We haven't even discovered what we can do with AI truly yet. And even if we're talking about aggregate infrastructure for all of these computing tasks that AI will perform, I mean, I see a pretty solid ramp ahead, even though the growth may be inconsistent. The only thing that'll throw that off the wagon, I think, will be a recession, in my opinion. And that's good. Ooh, Nancy, I'm going to take you on that one. Tariff is good. One way to keep the jobs in America. I disagree, but we'll talk about that in a second. Colin, shoot. What do you got?
Oh, I just wanted to, I think Josh Hager has a question in the Q&A thing that's been.
Oh my God, there's a Q&A question too.
Yep.
Gee, golly willikers. Let's hit that up. What do we got?
An updated question in regards to the most recent CNBC report of baby boomers, about 1.1 million leaving the job force every year over the next 15 years or so. How will this impact the overall job force over the next few years?
Oh, interesting. Yeah, so baby boomers leaving the job force. What's this going to happen? Will it open up those opportunities? Will those AI jobs, will those boomers who have been clutching on to jobs for years allow you to rise in your firm up to the level of manager or something else? And we'll see about this. And that's a good question. I think what we're seeing is we will continue to see in aggregate, there has been much said about a transfer of wealth from older generations to younger generations. I don't know. My family doesn't have wealth. But if they did, I suspect or your family's fortunate, or you have a parent or grandparent who might be older and they've got something cooking in there. I think that is going to happen, but I think it's not going to go individually to people. I think people will retire, the job market itself, those will open doors of opportunities. But to keep the American economy competitive, we have to make sure that those jobs that we're losing get filled in meaningful ways. What do I mean by that? So for instance, our net advantage truly, and what has benefited our economy is that we do attract the best and brightest from around the world. That is a absolute advantage of the United States. With our high wages and cost of living and pleasant, fearsome crime data compared to other first world countries, we have nonetheless attracted a lot of interesting folks. The interesting part will be, can we maintain that in a way that is counter to a lot of immigration is a very complex thing if we look at aggregate polling on this. People, of course, we have this very nativist reaction to things. We say, oh, people are coming in, they're taking my jobs. Most data will show us that in studies that have been done, the net benefits of immigration far outweigh the cost of immigration, particularly if they're younger, highly skilled professionals that can boost economic growth. And in that role, we have to be competitive. And to answer that question, I would say it will be our, because we do not have sufficient people domestically, and our birth rate is declining, and we have other, and like it is across the entire world, the economies that will attract immigrants will be more successful than those that won't in the next 100 years. That's what I believe, which is what I'm going to say. But now, tough schnoogies ahead. Tale of two economic policies, tariffs and rent control. So we got two things hitting the markets these days. Both I would fall under populist economics, and both cause the economics and finance profession. We all kind of have these deep, like, oh, no one listens to us, and nobody took an economics class, and then we have a little bit of a negative reaction to it. Aaron says we don't want boomers to stop working. That's true. If they kept working, that's good. And for that point, Aaron, that I brought up as well, declining in that labor force, and if it's people we can't bring back, that's bad. Nancy says, meant a lot of skills and talent will be missed. They're not replaceable. Take fabrication, machining, welding. Absolutely. All that knowledge has to be driven onto the next generation in a meaningful way. Absolutely, 100%. You're all right about that too. Now, tariffs and rent control explained. What do we do about this? So we've got two economic policies. I'll tell you the justification for them, what people think they'll do, and then I'll show you the economic research behind what they actually do. And, we'll have discussions about this overall. Fundamentally, I want to reiterate a couple of things. When I look for things, when I think about these things, I hate political. I'm not like a political nihilist sitting out here with a clove cigarette and reading a lot of Camus and, with a dreary look on my face at the absurdity of life's wonder without actually putting my foot into the policy space and asking and saying, hey, how can we legitimately make this better? And so any critiques that I offered, Stephanie, that's really good. I love it. That's kind of, what happened in my life. I'm watching an economics professor on Monday evening. Where did I go wrong? Thanks. That's hilarious. A+ for Stephanie. Rent control is one of the most destructive policy. Aaron says rent control is one of the most destructive policies in American history since 1940s. Sean says all the boomers were replaced by people younger than them, except the younger generation is smaller than the older generation, but we have to figure that one out. Brett says, Colin, burn it all down. Or Stephanie says, where did I go right? Bam. I love it. This is good. Also, by the way, Stephanie reached out to me on LinkedIn. She is an author as well and an editor. If you need editor or author or skills, buy her products, buy her book, buy her user editing talents as well. One day we'll write a book in economics and we'll have Stephanie edit it in a meaningful way. It's pretty good. It's a free plug. This is a good thing. I don't get paid for any of this, Stephanie, but gosh, if somebody can make money out of this gig, I'd love to see that. So tariffs. Trump proposed a 10% baseline tariff on all U.S. imports, 60% of tariff on imports from China. Using these revenues, his idea is to offset personal and corporate taxes, lower some of that taxes, and have basically what is a form of a consumption tax on the economy. So baseline tariff, try to protect all of these other industries, and the justification for this is, people see this and they see competition overseas. They see, I can't compete with the steel mill in China. I'm trying to work in a steel mill right now. I'm hustling. I'm doing my job. I'm being undercut in the workforce. So they see tariffs as a way out of this. Reduce trade deficits, generate revenue. However, oh yeah, by the way, reach out to Stephanie as well. Good. Make it happen. Justification. Protect domestic industries, reduce trade deficits, generate revenue. However, we have an extensive economic history about this. Tariffs do, in fact, do none of these things. So much so, I actually bought a shirt. I was going to wear it today. I asked my son to go fetch it. He couldn't find it. I was like, I put it on top of this to show it. But I can, I can show it to you because it's amusing. So I bought this shirt, which basically is kind of it might be too nerdy for me to even wear it, which is an extraordinary level of just personal nerdity. I'll dig it up here on Amazon on my past orders and I'll show you a picture. But the long story short on this is Here it is. Here, if you want to, it says this is the copy of the shirt that I purchased. Tariffs not only impose immense economic costs, but also fail to achieve their primary policy aims and foster political dysfunction along the way. That's kind of accurate economically. So I'm just saying, it's real. No one has the time to read someone's shirt that's that long, especially when I'm on a bus. I don't know why I bought it. I just felt particularly passionate about this topic. So, the take on tariffs. So, this has been a Trump thing, but Biden continued some of it as well. The turn towards protectionism, one of the justifications for it is, hey, this will reduce the trade deficit. What's the trade deficit? When we import more than we export from other countries, we have run a trade deficit. And there's a lot of reasons for that. For instance, we know that some countries produce stuff that's cheaper than us in aggregate by numbers, and they can do so because they have a labor force that isn't paid an awful lot of money to do it. There's currencies. There's the strength of the US dollar, which itself has been historically strong. But the trade balance, as it turns out, since 2010, it hasn't really budged despite all the protectionism that we've pushed out of here. Tariffs raise the cost of goods for consumers and businesses. I'm going to buy you a copy of this shirt, Nancy. It'll be great. Just let me know. I'll put it on. Send me an address. We'll make that happen. Tariffs raise the cost of goods for consumers and businesses. So what this does is we found the literature is when you raise costs of something, you pass that directly onto the consumer, almost directly in these characteristics. And here's the most terrible thing of all. Let's go back to 2002 for a second. 2002, steel tariffs. Designed to protect U.S. steel markets from other people. They made it more expensive to import steel from other countries. Those steel tariffs were designed to protect American workers and American firms. However, who else buys steel? Car companies do, automotive companies do, everybody buys steel. And so when they tallied everything up, the jobs saved in the steel industry versus the jobs lost in the automotive and all the other industries that relied on steel, the net loss was 197,000 jobs. So you save one thing. You say, you're my favorite. It's like if you have a bunch of children and you kept saying to the first child, you're my favorite child. I'm going to give you all the resources. But that's a terrible analogy. As you can see, I'm one of many children. One thing is this, the idea is if you save one industry, you're actually potentially hurting other industries down the line and your net cost may be greater. Bring this down to US automotive jobs. Trump steel tariffs, same thing. Automotive job losses from steel tariffs could equal about 29% of the entire steel workforce. And if I did this again, if we looked at this again, so Nancy says all truth, but the same truth for wage increases. Let's talk about this. A 10% across the board tariff likely results in about 2,500 more in taxes paid by the average US household because stuff gets more expensive. Looking at where that would fall on the right, materials and equipment for US businesses will be spending $1,000 more for that. Everything, automotive, autos, motorcycles, apparel, electronics, pharmaceutical, drugs, and food, all of those prices rise across the board. And the Tax Foundation estimates that even the Trump-Biden tariffs that have already been in place will reduce long-run GDP by 0.2%, capital stock by 0.1%, and employment by 142,000. And so you might believe in one of these or another one of these things, and that's great, and sunshine and rainbows. But even though it sounds good on paper, the facts don't really add up. And that's the bummer on this, is that when you make your economic decisions and policy, and here's what I want you to do. If you've got a question about policy, and even though your heart of hearts is like, it sounds like a great idea, and I'm with you, because I just want the things to work, and I want the things to be happy, and what's net for the economy. Do consider all these secondary and tertiary effects, because that is the effect of the economy on these things. A recent analysis, Peterson Institute of International Economics. So one of the things tossed out by the Trump administration, we should deport all the workers that we have right here. We deport 1 million workers, that would cause the US economy to shrink by 2%. Also, bad news bears, as it turns out. And all of this happening right now, when we have the greatest amount of factory investment that we've seen in like 100 years in the US economy. So people are trying to invest in US workers, but an increase in tariffs will actually harm the trajectory that we're on right now. Oh, Nancy, good points too, and I appreciate always debate as always, especially respectful ones like we see here. Last one was in the Bay Area, really sad. Most have been sold to other countries. That's true. And Sean says it's very similar to a value-added tax that they have in Europe. It's an implicit sales tax. Nancy says America cannot compete in unfair business practice places such as China. Tariff and various trade agreements were signed among the EU, South America, and Asia. All true. And again, and I point again, Nancy, of course, to the G7. The United States has lapped every large world economy that has been developed since COVID with our economic growth rate. And that's been the interesting fact that we have to address here. So even though our tariffs are up this way, tariffs do degrade us. If we can go back, actually, I'll take you back in time to the Gilded Age. A lot of people say, hey, we had tariffs in the Gilded Age. So as a consequence, wasn't that the cause of American exceptionalism? No, as it turns out. I got another paper I was kicking out here. Here's some more stuff on tariffs too. So Nancy, I got a couple charts just for you guys here. Tariffs and Growth in Late 19th Century America by the Dartmouth College economist Douglas Irwin. America didn't boom during the 19th century because it was a closed economy. The U.S. industrialized rapidly between 1833 and 1860 when tariffs were being cut. And as a consequence, Christopher Meissner from UC Davis noted in his 2004 book, basically, that although our economy grew, it grew in spite of the tariffs that we had, which is actually an interesting thing. And the China tariffs began in 2018. True. So Nancy, the question is, and I'm not disagreeing with, of course, the aspect that China has unfair business practices or other places. That's something that we can legislate in meaningful ways. But if we're thinking about jobs and bringing those jobs back, it is unlikely to say, and this is a hard question on this too. Can America legitimately compete in the same way that China can in these industries, which often are based on these sort of industrial era industries, which if we go back and, everyone, if you've been in this, whether if you're a child, you're an immigrant yourself or a recent immigrant in the last 2 generations, or if we go back 4 generations, look at the census records if you can, and look what your ancestors' jobs were, because they were working in these mills and these places that were these 12 and 14-hour days, like they're working in other places in the country. And that's not something we can bring back here in a meaningful way that it can compete. And the consequences are the prices are going to go up if that happens, and we'll have some economic problems. So even though China tariffs began in July 2018, that did not meaningfully move the needle on our manufacturing jobs. This is very good. This is going to be painful today for everyone. You're going to hate me after all this. I'm so sorry. Thank you for being your patient here. I got 33 people in this room. Thank you so much for being here tonight. It is a challenging environment. We're going to talk about those things now. So tariffs. Not pretty much a good thing. And I want to relate to a couple good things. Thank you, Stephanie. I appreciate it. It is medicine, but please counter it too with other things as well. Ultimately, I want everyone focused on what makes the economy better for the most people in this country most of the time in a meaningful way, and what policies work, what policies don't work. Tariffs usually don't work in that sense. They actually don't work. I can't think of an instance where they actually work to achieve the goals that we actually want them to do. So if you have a question, like Nancy brought up, very good points. This is what I want. They have unfair business practices. They're taking advantage of these things, and we're losing workers to them. What's going to actually bring them here that will drive and build that economy in a way that will result in the job outcomes that we actually want to see? Because tariffs don't get us there. Now we talk another one. This one's the hard one too. Because if anyone asks me personally, I am the #1 guy when it comes to, I want cheap housing for everyone. I want housing all the time. I want it to rain houses. I want you to walk outside your door and be confronted. I know, not, I'm like, I want this to be like the Wizard of Oz, where your biggest fear is to be trampled by a house falling on top of your head. But Biden says asking Congress to pass legislation to cap rent increases at 5% for corporate landlords, or risk losing tax breaks, and includes an exception for new construction. So we saw this rent control policy come out, and I believe Harris will confirm it, although she hasn't, I think, authoritatively said so yet. But the FHFA, the Federal Housing Authority, announced new actions to protect renters in properties financed by Fannie Mae, Freddie Mac loans. Hey, be nice, it's fine. Sean, be nice, it's cool. Nancy's looking for solutions. Sean, be respectful. Everybody in the room, be respectful down there. I love all you guys, but I want the Nancys and I want the Seans, and you both have good points, and that's good. I want to hear them, but be nice to each other. It's cool. I promise. This is good. Now, rent control, tricky thing. Now, okay. So rent control is a very interesting topic. Traditional rent control has, and I'll get into this, has a very bad record in economic papers. So when you read the White House documentation on this, it wasn't as bad as first. I think a lot of economists on Twitter were like, whoa, this is terrible. And you read it, and then like Justin Wolfers, I think, had a really nuanced view. He's like, well, I see what they're doing here. And, cap rent increases at 5%, corporate landlords corporate landlords who have over 50 units risk losing tax breaks, and excludes new construction to make sure the building keeps happening. This is designed by, it's like a non-economist and an economist got together and tried to figure out something that worked. However, still net, a populist idea rather than one that will achieve some of the policy aims we really want to achieve, which is cheaper rent overall. Justification for this makes sense. High rent increases continue to be a driver of a large amount of current inflation. So that's true. However, rent growth recently has decelerated massively. Here, where I live in New Mexico, they considered a statewide bill on rent control, but it was already too late. The rents had already started going down. So let's study what this means. Now, rent control has a lot of different flavors on this. In essence, if we look at basically every study on this, rent control's most positive thing is that it can, if you're growing very rapidly, if prices are if there's a very acute housing shortage and prices are in the double-digit growth territories, rent control can slow that down, and that's been the case in a couple papers. However, when we think about this, what it does ultimately is exacerbate housing shortages, reduce rental apartment quality, and limit the mobility of people between units. So how does it do it, and why does it do it? So what it does is, fundamentally, rent control reduces incentives to invest and build in things. Now, this policy said, well, we are excluding new construction. I think it will still affect the nature of our building trajectory and the economy, as people kind of look at this and say, well, if this is the start of rent control and it leads to additional policies, what else can come from that? Also, it's very strange to announce a rent control measure and anticipate it so that builders have years to anticipate it and act accordingly on that and change their investments to other things. So when you reduce the incentive to build things, units start coming off the market, and the quality of those units, because renters don't have an incentive to put back and build that quality, starts declining. So you end up having people in rent-controlled apartments, but the quality of those apartments has dropped, the building quality has dropped, and it also encourages the development of a black market. So basically, I know a rent-controlled apartment. I have a rent-controlled apartment. It becomes the politics of who you know. So when you sell it or offer it to a different person, you're relying on social networks instead of the market to determine these things. And these are often potentially equally unfair, or perhaps even more so. And a lot of studies have shown this, and this is kind of where it is. So this is like a chart: negative, positive, negative. So negative means less or fewer. Zero means no change. Positive means an increase. So controlled rents, when we think about this, it does reduce the rental price growth, indeed. But mobility, it reduces mobility. People feel trapped in it. Increases home ownership because people leave the rents and go out and buy homes when they can. But it really reduces construction. It reduces housing quality. And uncontrolled rents for housing that isn't controlled makes up for it. So if you're not in controlled housing, those rents start going through the roof. And so this is everybody with less than 50 units. So my guess is you'll see a whole bunch of shell corporations set up with 49 units that are immune to this, and they just increase their rents as much as they please. Supply, it really reduces supply in the long run, and it creates this positive misallocation of resources in a very positive way. Not a positive way, but in a bad way. There is more misallocation of resources. Local ordinances that limit rent increases for some housing units, such as in New York and San Francisco, have had local ordinances that limit rent increases have had a positive impact over the past 3 decades on the amount. Let me ask, I'm sorry, this is a question they asked a bunch of experts. Have local ordinances that limit rent increases in New York and San Francisco have had a positive impact over the 3 decades on the amount and quality of rental housing in the cities that have used them? And most people disagree with this in that sense, and that's experts. And you'd be like, well, what do accountants and finance people know anyway? Let's think about this as well. So what are the solutions? So perhaps one of the more adept solutions is, this is a fascinating conversation that I'm observing as it goes through in this. Oh, fun said. That's fun. That's right. So anyway, so what are the solutions ultimately around rent control in a meaningful way? Fundamentally, the thing that is anathema, I think, to people across the political spectrum because it involves a lot of issues, is you have to build more housing. Zoning is, in its nature, 100 years ago, a restrictive, often discriminatory measure designed to limit who lives in certain places. Zoning is a huge issue in the U.S. economy, and actually all of the English-speaking world. In fact, I would argue, and limiting housing fundamentally creates solutions where then you look at solutions like rent control and other issues instead of fundamentally addressing it at hand. And like I was advising our local housing policy office on this, I'm a big fan of all other means to increase housing supply. I'm a big fan of using every possible thing on the table. So this includes like we have an organization that supports mortgage development for individuals and families who are low income, all these other things. Let's get this happening. Let's get things cooking. But if you're trying to build 10, 20, 30 homes with a, for $300,000 a pop for affordable families, it's a drop in the bucket to the true need for housing in this country. So apartment completions are expected to be highest in 2024 in Austin, Raleigh, Charlotte, Salt Lake City, Phoenix, and lowest in San Francisco, Baltimore, San Diego, Pittsburgh, and Los Angeles. Now look at the rent growth over the last 12 months. This is not a coincidence. In the US, rent growth is more or less even on apartments, a little bit down. We're about down 1% from last year. But Austin, with more units coming online, down 7%. As it turns out, building is effective. If you build a lot of units, you can make prices even go down. Build, 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 build. That's true. Aaron, I agree with you. I went to Japan. I was in Osaka in March, and I was having a discussion with some students in Osaka. And I go, how much are you guys paying for rent? And they're like, they're paying the equivalent of $400 a month for rent in a city as big as Osaka, which is a New York-sized city in Japan. And because they can build, they have availability of building units. Of course, they're a declining population. You argue, well, but, so is it much of the Western world in the future? So let me go back here a little bit. Let's see if I can get this on board and read some of these comments. Aaron says we need to support the last 30% of non-home ownership with a home earned income tax mortgage credit, $20,000 a year for 5 years. That's very interesting. Build generational home ownership. Absolutely. Let's build those homes, though. Nancy says, you know that other countries don't allow foreigners to own assets in their countries. Indonesia, for example, a foreigner can own a home by him or herself. He or she has to have it for 100 years. That sounds terrifying. As a development strategy. I don't know if I want that as desirable or not. Aaron says we need outside FDI investment of trillions into the US, which allow the dollar, our debt investment, to be the strongest in the world. KT says, I respect this data about rent control. That being said, when I lived up north, my rent under a new landlord was raised 60%. That's not a typo. So I'm with you, KT, on this too. So you had this thing. People are absolutely exploited for their rents. And these things are like, why is this ever needed? And how would I do this? And to your point, if your landlord owned 30 units, they wouldn't even be covered by this particular policy, and they can rock and roll and give you another 60% increase this week anyway. Nancy says, unfortunately, a lot of single homes are being purchased by institutions and big investors. A recent report studied that. That's true in some senses. They estimate that the investor percentage of the market, I think, is 15 to 20% for the housing market right now, but it has been increasing in the last 15 years. Melanie says we need to destigmatize building prefab houses. Ooh, Melanie, boom goes the dynamite on that one. I'd give you that's a medal of an award. Absolutely. Post-war, a lot of people lived in mobile homes, still common outside the coastal US. Why not make adding the housing supply with compliant zoning? Factory-built houses. I would absolutely love a factory-built house of that same measure. This is great. Sean says, I suspect that there are too many variables in play to say that if you build it, they will come. I suspect that if we build a lot of houses, it will make rents go down. Stephanie says, $400 cries in California. My goodness, it's true, though. And it's not the saying that it's better or worse, but it's interesting. You can get, it's amazing that what freeing up a little zoning and building some stuff is good. Oh, that's interesting. Feasibility of structures such as electricity and water. That's true. Electricity consumption is on the rise, more at the boom of AI, and those are resources that we have to supply for people as well. But however, let's put it this way, which is more economical or effective or allowing people to sustain themselves or sustainable in the long run? A bunch of single family homes in a very large suburb, or a large, I don't know, imagine a tall skyscraper that where a lot of starting young people were able to build condos and build equity in units. We have a whole bunch of data that shows that owning something and building up that information, be it a small property or a starter home or something else, builds equity that allows you greater financial security for decades down the line. And those are more resource efficient in terms of water and power usage. So I don't think that we should be distracted from that as well. And I live in New Mexico, desert state. People say that all the time. We're like, oh, the water, we're going to have water. We're going to need water and all these things in the water. I'm like, yes, as it turns out, like, listen, everybody, I got a single family home in Santa Fe. My water bill is $80 a month and I'm watering my garden. I spend aggregates amount of money to grow a very small number of vegetables, which is very impractical. But I did harvest 5 tomatoes. Maybe that's worth it. But to that point, I just think that we've got this situation now where we have an option in this. And water is a thing too. You can observe some of the wastewater treatment and recycling facilities. Those are capital intensive, but there are solutions that we can do. And we see that around in a lot of places. Marcia says, without seeing the numbers, isn't a greater percentage of Japanese income taxes going to services that directly benefit individuals? Yes. As opposed to the US, where we have significantly higher military spending, yes, we do have a bigger slice of that pie. That is one of those questions. Dr. White is blasting. Thanks, Aaron. This meeting is wildly different than any in the last year. I'm sorry, am I taking too many opinions, Aaron? I appreciate this. I'm not trying to, I got to take an opinion on some of these issues, but I appreciate your patience with this. Julie says incomes are hilariously low in Japan. Senior income is like 50 or 60,000 US dollars or equivalent. That's also true too, as Julie points out. The wage gap between the US and Japan is a real thing. One of the factors that leads into this, we are a surprisingly, not surprisingly, if you study the data, we're a very well-paid workforce in aggregate, even though it often doesn't feel that way. But that being said, still for making real estate cheaper. Colin says, well, there's another solution. People are not having as many births. Lower population growth means less demand for housing. Maybe that's true in 30 or 40 years, Colin. We'll be ready for this. I'll be honing in on that abandoned shack in Kansas for retirement, and it'll be great. And I'll live like a king. That's true. We don't have those issues too. That's the other thing, is repurposing those housing. Aaron says, my tomato empire. There will be tomato. I know. Daniel Day-Lewis epic. I drink your milkshake. I drink it up. So the rental vacancy rate, 2023. So across the country, California at 4.4%, an impressively low rental vacancy, suggesting you need to build more things. Same in the Northeast of the country. Kentucky, surprisingly low rental vacancy rate. Anyone have a story of Kentucky's low rental vacancy rate? But in the growth states, especially across Texas and other places like that, you've got higher availability. Here in New Mexico, we're always a mediocre state in terms of our rental vacancy rate. Neither the worst nor the best, but we're right there, 5.8%. But then if you're living in the South Belt, inflation. So let's talk about our inflation rate. 3% year on year in June. Inflation fell 0.1% in June. 61% of current inflation has been shelter driven in the last year. Give me shelter. Man, 17% car insurance costs and 10% food. Rate cuts are coming, but here's the good news. 3% is a good target, and we got jazzed about it. We even jazzercised about that. And it's been a big deal to talk about, because one of the things we got to worry about with inflation is it is uneven. And the biggest chunk, of course, has been shelter, and that's been falling off as those rental rates have equalized, as more housing and multifamily housing has come into the market. We've seen some of that fall back. Motor vehicle insurance, still 17% of this year's inflation. Medical care, 7%. Food, a solid 10% of this. I'm Daniel Plainview.
Does this mean inflation is landlord driven?
Inflation is landlord driven. Inflation is shelter cost driven, which has a mixture of property owner effects. It has a mixture of general macro effects. So rates were really low. People wanted to buy homes. That drove up the price of houses. Then the price of houses rose so high that people couldn't afford houses. Then they went into the rental market. The rental market prices soared. That incentivized the building of a whole bunch of new multifamily units, as did COVID and the work from home thing. Those hit the market. That equalized rents. So we're just seeing this is falling off month by month by month. But because rents are, of course, delayed, what your rent was now, you probably locked in last year, the year before, the year before that, maybe just the last 6 months. Maybe you just signed up a new apartment lease. But in that case, rent is a lagged variable, and it's been falling off slower than other things. And because we don't see a lot of that increase in services, that is optimistic to suggest that perhaps we're doing what we can to nip inflation in the bud and give the Fed more confidence towards a rate cut.
Interesting.
Hmm. Melanie, California homeowners insurance is extortionate. Wow, that's interesting. I don't have that data, but I bet you it is. It does add to aggregate shelter costs and to the aggregate cost of owning a home in the market. But in this particular case, that's interesting. In this particular case, I would have to double check if that was in there. The vicious economy circle, says Nancy. Aaron says if you own a property that's being rented, then the tax valuation goes up. Property taxes, your improvements cost more. Your rates, if you borrow against it, then the rates went up. All that happens. Absolutely true. Colin, what else do you got? What else is cooking?
Well, used vehicles are cheap now.
That's true. How about this?
I'm looking
Using
at
your
that.
car, the Colin Moe story. Let's see if we can do this. That's good. When
I
in doubt.
mean, everyone remembers I'm driving a 24-year-old car, right?
Mm.
Um,
Yeah, I'm
but
like
like,
they're depreciating assets. My vehicle has 230,000 miles. I want to drive that until it collapses upon itself, until it rusts away and withers into the wind and blows away one morning when I'm driving to work 60 miles from here.
I'm just looking at like what's actually fallen. Furnishings and supplies. Furnishings, I know what that is. What is supplies? What's cheap now?
That's just stuff. Yes, so
What's cheap now? That's my question.
so energy is tricky. So furnishings and supplies is interesting. We saw furnishings and related household materials. So furnishings actually, oh gosh, I don't have this chart in front of me. They shut up during COVID because of supply chain issues, and they've been since clawing their way back. And so that's been a net positive for inflation because we've seen declines there. And basically, they're feeling the post-COVID bump slump is where they're at. In energy, of course, gas prices have come down, and that's a big piece of that. So it's working as a tailwind in reducing inflation. Aaron says, I told everyone a year ago to buy a world-class used Japanese or Korean car. I told everybody, buy a world-class. Where's your Lexus, everybody? Aaron. Thanks, Aaron. Thank you. Julie said, sounds like the best move to move in with parents and don't piss them off. Says Julie. Oh, isn't that one of life's great mysteries? How can you do those things? I know. Quickly, they have multiple children, become the favorite. How do you do? There's other things too. Here's other things as well. And you're like, well, is it good economy or bad economy? And back to some of the things that people are looking at. And one of the ways you might be feeling that, hey, it's bad. Did you know that we have the number of companies that have announced a bankruptcy between January and June are the highest level that we have seen since 2010 at 346. Very substantial number of bankruptcy filings. Not catastrophic, but it is a figure of note. Also, we had this as well. And so some other things I want to bring back in here because we've got earnings and other issues here. One person said, do you see signs for a coming recession? I think the election will be influential as to our economic trajectory. The stock market is interesting, actually. So here's one sign about a stock market. So this is answering the question, a couple of questions at once here. I had somebody ask, we answered the AA one, seeing signs about this. Have you seen signs for a coming recession or stock market correction? Have you seen great earnings in the market driving growth for jobs rather than layoffs this quarter? Do you feel this will drive the market through fall, and how much momentum with the strong dollar? And so do you think mid and small cap stocks will bounce back? Or will we continue to rely on only 30 companies pushing the economy like the Magnificent Seven? Pretty good. So here's what we got. So what I did here, dug up this little Bloomberg chart for you. Only 43% of firms. This is very interesting. So what is interesting in the story of analysts and earnings? When a company is publicly traded, it's followed by an analyst, and an analyst will project what the earnings will be. Ideally, in a unbiased situation, they'll follow the company. Their job is to follow it. They'll study every detail of the company. I teach in financial a market analysis class, and I teach them all the models that they use and all the other things. And they'll follow the company and they'll make an estimate of what the stock price will be. And then what analysts do is that many analysts can cover a company. For instance, Google or Microsoft might have 40 or more people covering them. And as a consequence, there'll be analysts who follow. Analysts do what's called herding. They tend to follow each other's recommendations, and everybody thinks that more or less Google will end up over here, and Apple will be over here, and Meta will be over here. And so everyone makes projections as to what quarterly earnings will be. Now, the fun part about 2020, 2021, 80% of companies were just rocketing through that market, beating what analyst projections were, sending excitement into the market. So this company beat projections. It did better than we thought it would. Positive surprise to the market. And what the market does, market loves positive surprises. That encourages investment, people coming into these companies and looking at things. However, in Q2, this year, only 43% of firms beat revenue expectations. You're like, oh, coin flip, 50-50. Maybe we're back to normal. Indeed, but this is the lowest number that we've seen. We saw a dip like this in 2019, and we really have to go back to kind of that quasi bad economy in 2015, 2016, which is really, really interesting. So companies are doing less well than they thought they would. So to answer this regarding your market questions, I'm a little bit nervous about this because it comes down to the money and it comes down to where if companies are making money, people invest in them, obviously. But if I look at our forward PE ratio, our forward price to earnings ratio kind of shows us how overvalued or undervalued a market may be. And so if I go back in time, what I'm going to do is I'm going to go to the Shiller PE ratio, and I'm going to share my screen on that for a second. We're going to do a little street finance here to answer this question. We'll go here. And this is the Shiller PE ratio. I take it from multiple because I find their calculations really good. Shiller is, of course, named after Robert Shiller, who never answered my email when I emailed him in grad school. So as a consequence, we never hit it off. I offered him to come speak at the University of Connecticut, where I was getting a PhD. He didn't even answer yes or no. So I've been sad about that for the last 20 years, 15 years now. But the Shiller PE ratio is a way to look at price divided by earnings. When the price is really, really high and the earnings are very, very low, you have a high PE ratio. That means the company might be overvalued. If you have a high amount of earnings, I should say, and a low price, that means your price divided by earnings ratio tends to be low. And as a consequence, you have a low PE ratio, and that's a company that might be undervalued and attract investors. And time again, we shuffle this into portfolios and run financial literature on them. Low price to earnings stocks in the long run outperform high price to earnings stocks. So it's a very interesting market anomaly. Right now across the market, since the 1880s or so, the long-term price to earnings ratio across the economy has been about 20. Right now it's sitting at about 35.23, which is pretty high. So it is high right now. It doesn't mean a crash is coming, but it does mean, if you're expecting the economy to increase, to grow and do more stuff, you got to see those earnings, and those earnings have to materialize for me to feel confident about that. And so I don't feel confident about mid or small caps. I think people are sticking with the companies they're comfortable with, and I think the market's going to be in for a little bit of a ride post-election with whoever is elected, in essence. I love that Sean's absolutely right. Best way to think about PE ratios is how much you pay per unit of profit. Right now, we have a really high price and the earnings aren't up to our long-term averages, but rates are also higher. Usually we get high PE ratios when rates are really, really low. And as a consequence, back in the 1980s, we had really low price to earnings ratios. That means companies were undervalued, people buying into them, that kind of stuff. But rates were really, really high across the economy. And so nobody wanted to put their money in the stock market because they could get 14% on bonds. And why would I want to put something in something as risky as the market? Meanwhile, right now, we still have a lot of people jamming on the market, but rates are still up. And so this has been a fascinating thing to see. So I don't know, but it'll be something that'll play out in the next bit of time here. So coming back here on these things, consumer sentiment went down. People are less confident about buying stuff. That is a thing. People go into this, and often that precedes recessions. That's a recession signal, but it's been really noisy for the last couple of years anyway. One thing, finally scored a point. You're in the penalty box, Sean. I've been appreciating you. You've been doing well. You've been speaking the truth in your own way. How are my dollars spent? Good question. One person asked, how are my tax dollars spent? Which I put as a slide, and I'm like, that's pretty good. As it turns out, we get money, and I like this particular chart from 2023 from USA Facts. There's a whole bunch of charts out there that explain this to you in different ways. But we collect money from individual income taxes, payroll taxes, corporate taxes, customs duties. When we spend more money than we actually have in revenue in a given year, that's called a deficit. And when deficits add up for 1 year, 2 year, 3 year, 5 year, that becomes our national debt. In the long run, that's a problem. Not going to keep you up late at night tonight, but be aware of it. So what do we spend all of our $6 trillion on? Biggest chunks, Social Security, National Defense and Veterans, Medicare, assistance, net interest on the debt itself increasing. It was about 6% of our budget was spent on servicing the debt we have. That's now up to about 10%. Transfers to states and other spending. And Albert's list, of course, the fifth biggest right here. Colin Mo's Shell Company. Mo money, mo problems. That's down here. They receive a lot of government support. Aaron says, don't forget state and local spending, which is another 4 trillion. Absolutely. When we do the Congressional Budget Office's upward revised baseline scenario, we're expecting to sit comfortably at around 135% debt to GDP for our national debt in 2034. But it might be higher depending on if the tax cuts are extended, more like 145%. And if we embark upon another Keynesian era sort of spending regime to stimulate a bad economy, it might be higher than that still. So not something that I think will affect us meaningfully in the next 15 years. Again, we think of debt to GDP as a useful ratio, but remember that our total wealth in our economy is about 140 trillion. But this will be a problem down the line eventually, if only because we'll be spending tons of money to service our debt, like Jamaica did back in the 1960s, 70s, 80s, and actually 90s. They've turned that around a bit in the last 10 years. San Francisco and San Jose, bringing it down local. Good news is we saw increases in non-farm employment in both areas in the Bay. We saw an uptick in government as well as information sector, which is a positive sign because it means that information isn't falling through the crater, as many of us might think. It is still there. It's still happening. It's just not doing a heck of a lot in terms of job growth. All right. Man, hold on. A couple other questions I got to answer. So we talked about that. Good earnings. What industry-specific jobs do you recommend for high school graduates to prioritize for better wages and cost of living? That's a really good question. So it depends. Healthcare offers a large number of opportunities. Healthcare needs aren't going away anywhere soon in the next 20 years. But I would also look at things if they're blue-collar work and other things, everything from good welders across the board to other trades are always going to be in demand. Particularly in this market, that's a tricky question. Post-secondary trainings and things, I think the moral of the story to prepare any high school graduate for is to have potentially multiple careers over their life. And I think that's fair to say. I think the expectation of a common career perpetually for 40 years is no longer as common as it once was and no longer as feasible as it once was. So get them prepared for variation. Ooh, I have this one too. How will the Chevron SCOTUS ruling impact how regulations are enforced and how will this affect the labor market? So, of course, what this is going to do in the SCOTUS ruling, of course, with Chevron, open the door for a whole bunch of regulation as it pertained from everything from FDA to EPA, Environmental Protection Agency rulings to be challenged because previously they had been interpreted as being that this is the will of Congress. And now they're saying the Supreme Court was like, well, maybe it's not the will of Congress. And so now litigants will come forward and start suing for some of these decisions that are made down. You're going to see a lawyering up on both sides of this equation. Your government will have to defend its regulations meaningfully and control. Government will have to be really, really tricky, hard about maintaining EPA rulings in a way that allows that are withstood in court. In the meantime, you're going to see this flurry of legislation for everybody that doesn't like or is opposed to a particular rule. Great for lawyers as it relates to the job market. So apart from that, I know Brett's like, who needs regulations when you've got delicious coal? There it is, keeping us warm. It's still, of course, a major thing of power, and no hate on people who made their money from coal. God knows it's a thing. And it's nobody's, I mean, there's not better jobs than others in these things, but we have to sort of look at and say, hey, what's going to be competitive for the U.S. economy in the future, and how do we develop and become better as a society? it's going to add a lot of tediousness across the board. And I don't have a lot of good answers other than I suspect more legislation and more trickery. I think more places will start to look like colleges probably do in that sense. And as an administrator of this bureaucratic beast, we have a lot of challenges that we have to do, but we are very liability cautious. So I suspect that people will act this way, which is going to be a stunning shock for, I think, a lot of people in the private sector, having been somebody who worked in the private sector before. Our cognitive regulatory capture is insane, Aaron says. Bum. Good for the lawyers, Brett. That's exactly right. Great earnings, we got that. I think I covered most of them. What did I miss? Anybody have any questions that they want to ask? No such thing as a dumb question. Thank you guys for being a little bit friendlier in the comments as we went through a couple of high profile issues.
I think I'm going to start, and I notice you have one more slide. I don't know if that's relevant.
Oh no, that's my junk side. That's my like I'm taking tariff. That's my tariff slide.
Oh,
I
okay.
anticipated tariff pushback, so that was good. That's gonna
I
be
think so. To kind of bring this back to the purpose of Albert's list, which is, helping job seekers find jobs, helping job seekers navigate the job market, and understanding, where they should be spending their time and putting in their efforts. I guess a few guided questions would be, what industries are the best, to be looking at right now and going into the next 12 months, maybe? What industry is suffering? So if you feel like you're suffering in that industry, you're not alone. And for Bay Area, which is probably mostly tech workers, what industries would you recommend tech workers bring their skill set to, um, if the information sector is not doing well?
Ooh, okay, great question. So let's talk about industries. So that's one of those things, Colin. I wish I love the way you thought through this, because at first I was like, like industries, I could cop out and be like, well, industries vary from year to year. I take my imaginary cigar and I just put it out on a widow or an orphan, or no, it's one of those things. It is so challenging to anticipate this. There are a few things that I think aren't going to go away. I think actually, and this is going to be tricky. Even though governments bounce back a little bit, that's going to be real choppy depending on the presidential election, who comes in afterwards. I think you'll see some volatility there. I think healthcare in supportive services, because there's not even a reasonable amount of policy-based legislation that's coming down against it to suggest it will change, other than demographic variables. The macro side of the healthcare equation is so great. It's going to continue to push into this market. And as a consequence, for better or for worse, you'll see support jobs across the board in there. So that does include things like the folks designing like the software utilized or by these companies and other things, or medical record, corporate software, all that stuff is all jamming. On the other side of that, though, so you asked a couple other things for the next year or two, and I think especially if you're looking at a tech resume and you've got these skills, even though you might have been familiar, maybe you were a Google guy or a Meta person or who knows, and you started your work in some industry, those are very marketable skills across the board. And, companies do not have the wherewithal in other places, especially outside of the Bay Area, to handle some of the difficult questions overall. Much has been said. I was talking with a cybersecurity professional last weekend. I was in Baltimore, and we were talking about this, and we talked about upskilling in cybersecurity, looking at different things in different industries. And even though, he got a sense that the market was not as great as it was a couple of years back. So he's, signing on, he's taking the test, and, people are looking at master's programs and trying to differentiate themselves in the marketplace. That is still fundamentally a long-term positive growth space in the industry. Also, I think that things where you can be nervous about, information is always going to be volatile. Stay on your feet and do it. I want to shout out to the gig workers in particular. As money dries up, companies become less keen about spending in certain areas. They start hiring for skills they don't have as permanent positions, and they start reducing their contract load with you once they think they figured it out. And so you'll be experiencing volatility in the sector. And whether it's a side hustle or your primary gig, I think you'll be in a situation where you're going to have to be above and beyond in marketing your skill set, marketing what you can do to a wider swath of companies than what you may be doing right now. A lot of times it's word of mouth for gigs, right? You get a contract, you're working as a client in this role, it's a particular amount of time. Maybe it's a job, maybe it's a project, maybe it's something else. You're going to have to market yourself in a much more in a much stronger way. So I mean, that's what I think is going to come down to this. Oh, this is cool. We got some links coming down the board. Industrial automation, be ready to move. An AI lawyer for industrial automation. Melanie, we're shooting for the stars here tonight, folks, kids. This is just great. Oh my gosh, states with the highest job growth. Look at that. Number one is Alaska. I just went to Alaska in June. I loved a state where every single person I met was surly. Everyone was this. I went to Barrow, Alaska, in fact, and I'm like, this place doesn't want me to be here. It is very cold. I don't want to be here, but we had an understanding. Great time, great stuff here, Aaron. Great links. I love it. So Aaron's got some additional links for that too. So keep an eye. If you got to move, you got to move, and that's the thing too. But yeah, there's a trick in this too. Mobility is a big issue, and you have to stay where your support structures and your family and friends are. But if that opportunity, it does exist across the country, even if it takes you away from building the Bay Area economy in the future, that is something that you should be able to do so. Oh yeah, JOLTS too. We got to talk about JOLTS too. Gosh, there's so many things. Job openings about 8.1 million. We'll get some bigger JOLTS data. That reminds me, Aaron, next issue in our August sesh for this session. Great question, Colin. So not really. Healthcare will be rocking it. Aaron's links will be rocking it. Gig workers are going to have a bit of a ride through this. That's what I think is going to happen. Industrial automation. Sure, absolutely. Dress up as a robot, work for a company.
Something I've often heard economists say is new technologies always bring around new jobs.
Yes.
I guess what most people are worried about is AI is going to be a net decrease in jobs because of what it can do. Do you foresee that being true?
No, I don't foresee that to be true. But that's because it's never really been the case but here's, okay, to history. Technologies happen, increased productivity. They are not even in the sense that job losses do occur. But jobs are created in other places, industries are created, society moves onward. We have not seen a situation where technology has meaningfully resulted in job losses sustained across the economy in a negative way. Right now, however, AI is a new technology. AI is something we have never seen before. And I appreciate that. And that's a big deal. And that's a really, really outstanding measure. However, AI's biggest benefit and its fundamental boon is the hope for AI is it will it will turn around the stasis in productivity growth we have witnessed in the last 10 years, basically, in the last 5 in particular, where productivity has basically plateaued in this country and send us on a path to greater productivity. Higher standards of living. We need better technology, which increases productivity, or we need more people to help build a bigger economy. Economic growth. You need more people, you need more jobs, you need more productivity. It's the people equation is not going to happen as much. I think we're going to have a lot of pushback against immigration. I think there's going to be pushback and the birth rates aren't going to come back. And that's fine and reasonable. I have one child and that's it's very expensive and I get it. And these are, and immigration is also a very hot button topic. And so our growth of the economy is going to be based on productivity. As productivity increases, it has the effect of improving productivity across many different industries. And to my point earlier, AI's transformation is going to be multi-decades in length. It's not going to be a light switch that turns on and says, hey, I don't need any novel writers anymore because AI just wrote the greatest novel ever told. I mean, I've read a bunch of AI novels, man. I mean, it's I haven't read a bunch, actually. I've gotten through 5 pages. But And I've been like, man, this has a, ooh, I don't want to hear this. So Brett says 102 kids will be about to be in college. That's plenty. Godspeed, Brett, and whatever you do, send them. Pick a favorite and either send them to two cheap colleges or send your favorite to an expensive college and the other one somewhere else. Let's rock and roll. Send to UNM. We got him. Stephanie says, as a project manager, AI has the potential to automate basic coordination so that more attention can be paid, to actual processes. This issue will be companies thinking that AI can do more than it can. Conservatively applied, it's a solid tool. I'm in agreement with that too. So it's Stephanie, of course, in project management, as well as if there are skills there that can help people with Stephanie's project management and an editor background around the system. I think we'll see that overall. I think more work's going to get done, which will in turn open up opportunities for jobs elsewhere. Staffing indicator. Oh, that's fun. I love these links he's rocking and rolling with Aaron today. An AI PM would be far better than the ones I deal with on a daily project basis at work, says Sean. Brett says, I'm cautiously optimistic for them. It's me trying to keep plugging away to support them. Oh, Natanya, what is your rating on how the Fed has handled the economy? Are they ignoring warning signs from the economy and falling into old patterns, doing a rate cut too late, which in the past has followed a recession? That is also an excellent question. So in this particular case, the Fed is trying to thread the needle for the first time. We have never initiated a series of rate hikes like the ones we've seen and not encountered a recession beforehand. This is the first time, hypothetically, if we can nail the landing, where we could raise rates as quickly as we've had, have an inverted yield curve where those short-term rates are higher than those long-term rates, which have predicted every last recession since the 1960s. And as a consequence, Jerome Powell is really trying desperately to nip inflation in the bud meaningfully. I think it is intentional. And although many of my colleagues argued very passionately last year that we should have been cutting rates, right now, I think I would actually say that we should see them if we can cut rates by the end of the year, it may not be too late. But I don't know. There's a lot of things could go wrong. We've been lucky too. We haven't faced a large geopolitical crisis that has negatively impacted our American economy in a significant way, like an oil shock or something else. When that stuff happens, that has a magnified effect and that can start a series of things happening. If, for instance, another reason we were lucky, if the Treasury hadn't stepped in and saved those banks in March of last year with their federal loan services, we would have had a banking crisis last year. Absolutely. And that would have led to a recession. We've gotten very, very lucky. And we can't look back and say this has been intentional or not, but luck is always part of the equation in anyone's life. We have to look at our merits and our luck. We try hard, but sometimes we're in the right place at the right time. Jerome Powell, for better or for worse, has been very lucky so far in the role and handling of this economy. And if he continues to do so, that would be good. But I think it is time now. The talking heads on Bloomberg have argued that the New York Stock Exchange, this is from Sean, have priced in a rate cut in September. I think I might throw my hats in with them. I would love to see a rate cut in September. But if they delay it another 6 months, I probably will be more of the belief that they're not following the warning signs and that it'll be too late. Steering a battleship really is. You cut rates, we're still going to we won't see an immediate impact. Aaron says both parties should have middle-class tax cut of $3,000 per person, which would be a kick consumption back into gear. Oh, wouldn't that be nice? Consumer sentiments, not particularly good right now. Things are flying. So maybe, oh gosh, maybe the AI president of the future. They'll have an answer.
Is 3K even a month of rent now?
3K.
As a final question,
4 days of rent.
Does recession usually result in distribution of wealth or concentration of wealth?
Depends on the recession, incidentally. Last recession, the COVID recession, so it depends what the government does in response to recession. I got an answer for that one. So last recession, we saw a decline in inequality, meaning that we became less unequal for the first time in a bit of time. And that was because the recession was One of the projects to build back the economy after the recession were things like child tax credits, transfers that helped the lowest quartile of individuals, and that substantially reduced that pressure. Also, the wage growth we saw in leisure and hospitality, the double-digit wage growth helped reduce that inequality. We still have an incredibly unequal system, but that actually reduced it for the first time in a little while. If I get, and let me bring up some Gini coefficient information for you guys. The Gini, Gini coefficient, kind of is a nice, easy way of looking at inequality in the economy. I'm trying to get one that's been updated a little bit more recently than this. Gini index. The Fed stopped carrying this after 2021, but you can see the drop in this one. I'm sorry, let me take this to everybody, hosts and panelists. That's just to Colin. If I can get Gini coefficient in the United States actually dropped.
Wait, why did the Fed stop caring about inequality?
They
That's
just changed. No, they changed their measurement factor here. It's expected. There it is here. I got to get the right. I got to get the right data point. They're focused. They have other things. They're trying to gosh, because they have the Federal Reserve economic data has a whole bunch of series on this, and I got to select the right series, the one that reflects it. And then sometimes their data becomes a little stale, and they say no, 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 you need to use this one instead. So they have these other metrics. So let me just grab that Gini coefficient 2024 Wikipedia article. World Population Review has some data on it, but it's not historically read. So yeah, our Gini coefficient in 2021 dropped below 40 for the first time in a little while, which was really pleasant. It goes from 0 to 1. 1 means all the wealth is concentrated in a single individual. 0 means it's completely spread out. And so you find a lot of European countries have lower Gini coefficients, and countries like the United States have a higher Gini coefficient. And so it got a little better in the last recession. However, in previous recessions, depending on the sector it affects, it can further concentration of wealth in certain areas, and it can do other things or not have a big effect overall. I just need a
I just
US.
realized I've been alive for the highest inequality of USA since the
Isn't that great? Aren't you proud of that number? So here's another one. Statista has that as well. Statista. Let me see if I can grab that for you. I can't share this. Maybe I'll share this. Just real quick for the people in the cheap seats, household income Gini coefficient. Income inequality in the United States from 1990 to 2022. Boom, last recession we dropped inequality. But as you know, like 2008, there's no post 08 recession, inequality continued to increase. Inequality has been on the up and up, but we saw it decrease a little bit. And it's likely in the scope of time, it will be temporary, but it'll be interesting to see how long it lasts. Colin says, I just realized since inequality since birth. That's right. It's gotten worse, which is true, but that's one of the things that we have to figure out. Brett says inequality is a feature, not a bug. It's a thing. It's a thing that happens. It is true. Well, maybe there's a thing that we have to do. We can certainly be better about this. I think a good economy too. We should have, if we value ourselves truly as an economy or one of the we look at the question of what is capitalism or what is a free market economy and what are all these things, and we know that capitalism tends towards oligopolies, which is not the free market. We need competition, we need meritocracies, we need some level of information, and unfortunately, information differences that exist across the system, including and where people are born and the nature of how they're able to rise or not rise above those circumstances are often based on circumstances out of their control. And so we have to do something more systematically, perhaps, to address some of those issues, including with education. So anyway, it's Colin's phone. That's right. Yeah, I agree with this. I'll just stop
I'm
talking about
just
it.
like looking at this.
Colin's called in. Yeah, I'll hop in on that bandwagon. Colin is the cause of inequality in this country. This is right. There we go. Let's just.
What happened in 1980? Why did it shoot up so fast?
Colin, what age were you when you came of age? Was it? I'm just trying to figure out what happened in 1992 when it shot up this high?
Well, I was born that year.
Oh, really? There it is.
I was born
There it
into
is.
inequality.
I've got a paper I'm going to write right now. The Colin effect. Inequality in the United States for the last 30 years. Look at it go. Look at it
I'm
go.
just, yeah, this is actually kind of depressing. I've never known a time under the Gini coefficient of 38, apparently.
That's right. That's a great title for your autobiography. I never knew a low Gini coefficient in my life. I don't remember what it's like. Levittown and the post-war economy and the hopes and dreams of the 1950s. Nope, not here. Just inequality. And then it's one of those things. It's true though. One of those things though, there are things that we can do, of course. And the problem is though, it's a feature of you don't want an absolute unequal system, even if it is perceived. Then you are that's a whole other economic debate. There is cost to it in economic inequality that transcend even just aggregate GDP numbers, and you have to make your system in a way that people at least have enough wherewithal to make it believable that if they put forth additional effort, they'll achieve an additional return. And that's important to do, and it's much harder to do if you have a cabal of highly wealthy individuals who control a lot of different things in the economy and you say, hey, just work hard and do it. And they're like, no, no, I'll hire my son instead, which will be one of those things.
Can we compare Gini coefficients with other first world countries? And how are we doing?
Yes. If we wiki the Gini coefficients, okay, one thing. I think Wikipedia had a cool article. Wikipedia broke this out, I think. If we looked up physical Gini coefficients, I think they had a list, but let me see if they still do this. Oh gosh, they have all these the fun mathematical explanations of it. It's great. Let me see it.
I'm now
Is
curious.
list of countries by
How
G.
are we doing against like Australia,
Oh, we're how are we doing? Oh man. All right,
China?
here's what we got. For Colin and the members of the A team who are sticking around way late for us today. But here's what we got: list of countries by this. So we've got South Africa. Let me zoom in this. Let me increase the size of this real quick here. See if I can do this here. So losing the World Bank numbers because World Bank. South Africa 0.63 Gini coefficient, highest in the world. You got your Namibia, Colombia, you've got Swaziland, now Eswatini, you've got Hong Kong, Belize, Botswana, Brazil. And coming in, where's the United States fit in there? We're not the worst, as it turns out. Where are we, actually? Where are we? Let's look us here. We are number 56 at 39.8 in 2021. Our data is a little stale, but right there between Micronesia and Morocco, Colin. Not so bad whatsoever. You know,
But let's just look at the like
not a lot of
5.
developed countries in the high Singapore, interestingly, of course. They rely, of course, on a lot of workers from other countries as well. Letting the genie out of the bottle.
I only
Oh
want
my
to care
God,
about like the
Marsha,
top 5
hilarious.
economies.
10,000. That's the joke of egg par excellence award. I appreciate that. Very nice. So you've got the United States right there. You've got Gambia, Laos, and then suddenly, when do we start running into other countries?
Wait, China is doing better than us?
Yeah, Russia's got 36. China's doing better. Liberia's doing better than us. Italy, they're 34.8. Portugal, Australia at 34. So again, 0 to 100, lower numbers means more equal. New Zealand, 33. Spain, Switzerland, and you can go all the way down. Bosnia, Japan is at 32. The UK even at 32. And so a lot of countries going down here. I can just keep cooking with Crisco. We go all the way down. Faroe Islands, impressively, 22. Slovakia, one of the nations of my ancestry, 24 on this, but that dates from 1996. That's a stale number. A lot of these older numbers that are small are actually not recently updated, and as a consequence, that's tricky to evaluate. That dates from 2018, I'm sorry. So 24, 25, Moldova, Ukraine, Belarus, Iceland, Czech Republic. So a lot of noise here in this particular situation.
So we're
Third,
bottom third of the
uh,
world, if my math is right.
oh yes, we are. Yeah,
We're at
we're
the bottom
really
third of
yeah,
equality compared to the rest of the world.
we're a very unequal country for a developed nation. That is,
Yeah, this
but
if we went higher, would economists start, blowing a whistle, something like that? Like what, like for example, if our Gini coefficient reached 60, at what point do economists, you know, call a meeting with the White House and say, "Hey, we're kind of unequal. Congress, would you like to do something about this?"
I like that economists. I don't know if we have whistles. That's a really fun. Ha. Let's see if we can. Yeah, we have like a pen flute that we play, and it sounds just like a song though when we play it. So people just dance. So we don't really have a warning sign. So that's, trust me, it's true, and it's more profound than people realize. I think it's a tricky situation because we look at the question of inequality and it becomes a tricky one. So obviously, too low inequality and too high inequality might be situations where there's an imbalance between resource allocation in the state. But Aaron says, if you haven't been to those so-called deep red states and blue states and those red states and purple, well, interesting. Not sure if there's time for this question. Natanya asks, is the high-level takeaway for current job seekers that the job market for white collar will be still bad for the rest of this year, even if there's a fate rate cut in September? Yeah, so the rate cuts isn't going to change the job market overnight. So Natanya, I would view the rate cuts as a long-term boon to the economy, but over many years, over 2, 3, 4 years down the line, it will improve the economy. But we're going to continue to be in a constricting job market, not a truly bad one, but one that will continue to have challenges, regardless of the rate cut. And that's what I feel about that one. For the one, EU is 30 or so and are 38. Just wow, this is really interesting. There we go. Yeah, Aaron's got the link there too on Eurostat. But again, South Africa is worse.
That's not a very
I don't know.
a very comforting thought. Where I see. All right. We have significantly gone over time. Oh, hello, there's Little White.
That's little. Yes, that's his name. Micro White. Off White.
All
But
right.
yes, he's there. It's bedtime. We always like, I rock and roll these things.
This was fun. It is
I'm not repeating that one, Aaron. That's
thank you to everyone who overstayed. We had quite the best conversations always happen after the official time. With that, we hope you feel more informed about the job market, the future prospects, whether rates are coming, and whether or not your stock market picks are going to do well. We hope to see you next month when we do this again. And thank you, Dr. White, for your presentation as usual, and thank you for answering all the questions that we came up with. And with that, have a great. Oh, Brett, you raised your hand.
Oh, thank you, everyone, too. Your comments are so nice. That keeps me going on this. I really appreciate all of you for coming. Thank you, Edna, Melanie, Stephanie, KT, Aaron, Nancy, Brett, the whole gang. You guys all rock.
Yes, thank you to everybody. And with that, this was recorded and will be put on YouTube within 7 days, hopefully. And then with that, have a nice evening and go watch the Olympics.
Yeah, it's time. Which economist will take home the gold?